Canadian mortgage arrears have reached recession levels. That is not a projection. It is the current data. At the same time, National Bank of Canada just hit a 52-week high. Its shares crossed $192.84 this week. Both of those things are true simultaneously. And that gap is the entire story. The conventional read on Canadian banks right now is straightforward. Housing stress is building, the mortgage renewal wave is compressing household budgets, and bank credit quality is quietly deteriorating. The bears have been making this case for 2 years. What keeps disrupting that narrative is the market itself. If arrears at recession levels were a leading indicator of bank earnings damage, the stocks would be pricing it in. National Bank is doing the opposite. So either the market is complacent or the arrears data is telling a more complicated story than the headline suggests. Working through that tension is where the actual analysis lives. 1 million Canadian homeowners are renewing 5-year fixed mortgages this year. That is not a forecast. RateHub confirmed the figure. For a typical buyer who purchased a $696,000 home with a 10% down payment, renewal means a 24% increase in monthly payments. In cash terms, that is $622 more per month, every month, starting now. The mortgage meltdown that analysts predicted from this hasn't arrived. Defaults remain relatively low. Banks are offering more renewal flexibility than they have historically, which is absorbing some of the shock. But the absence of defaults is not the same as the absence of stress. Consumer confidence in Canada just hit an 11-month low. Rents are falling, even as landlords face higher interest costs. The condo segment in Toronto is under particular pressure, with investor listings adding supply into a market where rental demand is softening. Toronto benchmark home prices have now fallen back to levels last seen in late 2020. 6 years of price appreciation erased. Here is what matters for the bank specifically. The flexibility being offered at renewal is not charity. It is a strategic deferral. Banks are restructuring amortizations, extending terms, and absorbing short-term income recognition changes to avoid triggering arrears. The arrears figure that has already reached recession levels reflects the cases where that flexibility wasn't enough. The question is how large the deferred stress pool actually is behind the reported number. Then, in the past 2 weeks, fixed mortgage rates moved 40 basis points higher. The Middle East conflict is generating an inflation uncertainty premium in bond markets. Consumer confidence was already at an 11-month low before that rate move. The renewal cohort hitting the market now is renewing into a more expensive environment than the cohort from 3 months ago. The 1.5 million Canadians who already renewed pandemic-era mortgages absorbed their payment shock. The 1 million renewing this year are absorbing it now with rates moving against them in real time. This is the point that tends to get missed when the headline reads, Canadian Banks. National Bank's 52-week high is real and its fundamentals support it. A 15.85% net margin and a 12.83% return on equity are not accident numbers. Scotiabank set a target of C$202. BMO Capital Markets moved to C$195. The consensus sits at C$190.27, meaning even analysts who are cautious are above where it was trading a month ago. But National Bank's mortgage book is structurally different from Royal Bank, TD, BMO, or CIBC. Its exposure is tilted more toward Quebec, where the housing market never inflated to the same degree as Toronto or Vancouver. Quebec borrowers renewing now face a smaller absolute payment shock than GTA borrowers. The arrears dynamic in Ontario and British Columbia is not evenly distributed across the country, and it is not evenly distributed across the banks. What the market may be doing is correctly pricing National Bank as a relative winner within a sector under pressure. That is not the same as saying the sector is fine. The broader Big Six banks carry far heavier exposure to Ontario real estate. CMHC-insured loans provide a credit backstop, but they do not eliminate the earnings impact from restructured amortizations, provisioning costs, and net interest margin compression. Those costs show up in quarters ahead, not quarters past. Canada also reported stronger than expected growth recently, suggesting the tariff war with the United States is having a more muted economic impact than feared. That is a legitimate upside input. A resilient labor market is the primary reason arrears haven't cascaded into defaults yet. Employment is the load-bearing variable in this entire structure. The scenario that resolves stress without a credit event requires a specific sequence. Geopolitical uncertainty has to stabilize enough that bond markets stop pricing in inflation risk. Fixed rates need to stop climbing and preferably retrace. The labor market has to hold, because it is the primary buffer between payment stress and actual default. Canadian economic growth, which surprised to the upside recently, needs to continue absorbing the tariff impact. If that sequence holds, the renewal wave becomes a drag on consumer spending rather than a banking crisis. Banks take margin compression but avoid meaningful provisioning spikes. National Bank's 52-week high starts to look like the sector finding a floor, not an outlier. The scenario that develops into a more serious credit event is less forgiving. A 40 basis point rate move in 2 weeks is a signal, not noise. If geopolitical tension sustains elevated bond yields, the cost of renewing this year's cohort increases further. Falling rents and rising carrying costs are already forcing some landlords toward disposition decisions. Condo inventory in Toronto is at multi-year highs. If that inventory continues building into a buyer's market while rates stay elevated, price declines accelerate beyond the 2020 retracement already recorded. In that environment, the deferred stress pool behind the current arrears number starts converting to losses. The banks with heavier Ontario exposure feel it first. The evidence leans toward the slower burn path rather than a sudden break. Recession-level arrears with still contained defaults suggests the system is stressed but not breaking. The flexibility banks are showing at renewal is buying time, and time matters if rates stabilize. But buying time is not the same as resolving the underlying math. 1 million renewals this year, another cohort behind them, and fixed rates that just moved 40 basis points in a fortnight. The pressure is accumulating, not dissipating. National Bank at a 52-week high, and mortgage arrears at recession levels are not contradictory data points. They are two accurate readings of the same system, taken from different vantage points. The sector is not uniform, and neither is the risk.